Month over month, sales charts point straight up. But when executives check the actual bank accounts, cash reserves are steadily bleeding into the negative. Evaluating a company's health by looking at aggregate financial statements, comparing total revenue to total expenses, creates a massive blind spot. These top-line numbers obscure the underlying mechanics of your growth. They hide structural inefficiencies operating deep within your sales and marketing engines. To diagnose true scalability, you have to abandon the aggregate view. You need to strip the business down and evaluate profitability at the atomic level, the economics of a single customer unit. This is the practice of unit economics. It isolates your profit and loss down to the acquisition and lifespan of one individual buyer. The entire model rests on two master variables. The first is customer acquisition cost, or CAC. This is the exact amount of financial energy required to convince one person to buy. The second variable is lifetime value, or LTV. This represents the total financial return that single buyer yields over the duration of their relationship with your company. The strict mathematical relationship between what it costs to acquire a customer and what they eventually pay you acts as the ultimate diagnostic pulse. It separates a genuinely scalable business from one trapped in a financial death spiral. A common operational mistake is assuming that customer acquisition cost is simply your digital ad budget. Real financial modeling requires calculating a fully loaded CAC. This captures a much wider spectrum of operational expenses. Look at this visual scale. The denominator must include hidden acquisition costs, sales salaries, commissions, CRM software, and event overhead. When correctly calculated, the fully loaded CAC is often 3 to 4 times higher than initial estimates. That brings us to the second critical error, calculating customer lifetime value based on gross revenue. Rigorous LTV modeling demands slicing revenue down. Discard costs of goods sold and calculate strictly using gross margin. Plugging top-line revenue into unit economics creates a false positive, making structurally unprofitable customers look like assets. Relying on ad spend for CAC and gross revenue for LTV is the primary reason seemingly successful companies aggressively scale themselves straight into bankruptcy. Apply these rigorous definitions to a real-world scenario. Consider a B2B distributor selling industrial coffee machines. This dashboard isolates baseline economics. A machine sale yields a $10,000 margin, but fully loaded acquisition costs are $20,000, leaving a 0.5 to 1 ratio. Evaluated as a one-off sale, this sparks executive panic, triggering mandates to fire sales teams. Evaluating a customer strictly by their initial point of sale transaction completely blinds leadership to the actual architecture of business growth. To find the actual value, we have to execute a strategic pivot. The machine sale is the entry point to a multi-year ecosystem of supply and service. Let's introduce hidden variables. Recurring coffee bean deliveries add $72,000 over 3 years. Adding contracted annual maintenance expands the initial $10,000 LTV block into a massive $97,000 asset. Our failing 0.5 to 1 ratio shifts into a highly profitable 4.85 to 1. The executive mandate completely reverses. Instead of firing the sales team, the CEO must immediately double their hiring budget. Mastering unit economics empowers executives to confidently absorb severe upfront acquisition losses, knowing they are mathematically guaranteed to secure heavy long-term margins. Strategists use the LTV to CAC ratio spectrum as a tactical dashboard. It acts as a throttle for company growth, dictating exactly when to accelerate. Operating below 1 to 1 is value destruction. Hitting exactly 1 to 1 creates a zombie company, a business that survives but generates zero capital for future innovation. The 3 to 1 zone is the golden ratio. It represents the optimal structural balance between aggressive acquisition and healthy margin retention. But pushing past 5 to 1 creates a paradox. Generating $5,000 for every $1,000 spent seems like hyper-success, but it is actually a warning sign. A massively high ratio indicates market timidity. It means you are severely underinvesting in customer acquisition. Hoarding profit to keep your ratio above 5 to 1 is a strategic failure. By refusing to spend, you directly cede potential market share to bolder competitors who are willing to pay more to acquire those exact same customers. There is one operational constraint that can kill a company, even if it maintains a perfect 3 to 1 ratio: the payback period. If your payback period exceeds 12 months, it causes a fatal cash flow choke. The company will simply starve of operating capital while waiting for that lifetime value to actually materialize. Protecting these metrics requires strict organizational alignment, starting with how you structure your sales commission plans. If sales teams are compensated only on the initial close, they will actively abandon clients. This destroys the lifetime value that the entire business model relies upon. They must be incentivized directly on retention. Investor Mark Cuban defines this mathematical distinction clearly. If your revenue is greater than your expenses, you survive. But if you know deeply that your revenue per customer is greater than the cost to acquire them, you will be rich. Sustainable scale is the direct result of rigorously applied, fully loaded mathematics.